Okay, I'm reading from the Reference Guide to Regulatory Compliance, and I'm on page 215. Talking about lending limits as per the OCC. And there's general lending limits for national banks and savings associations, and that is generally not to exceed 15% of the bank's capital and surplus. There are special lending limits that I discussed where you can go over 35% of that 15% number if the loan's being secured by bills of lading or warehouse receipts, if they're being secured up to 115% of the outstanding loan amount. Some criteria there for the types of bills of lading and warehouse receipts that are securing the loan. Same is true for the special lending limits for discount of installment consumer paper, which is when you have consumer paper such as automobiles, mobile homes, residences, office equipment, household items, tuition fees, insurance, premium fees, and other consumer items that are of partial recourse to the seller. There's an additional 10% over the 15% bank's capital and surplus that can be lended for the discount of installment consumer paper under those circumstances. And for further special lending limits for loans secured by livestock, there's an additional 10% over the 15% of the bank's capital and surplus, as long as the livestock meets the specifications and are valued at 115% of the loan balance. And same is relatively true for loans secured by dairy cattle. And then there's a special lending limit for savings associations, which is a little hard to understand, but it does allow for loans up to $30 million for or 30%, okay, I get it, or 30% of the association's unimpaired capital and unimpaired surplus for the purpose of developing domestic and residential housing units, when the savings association lending limit would be less than $500,000 when it's being calculated as 15% of the bank's capital and surplus. The other section under general and special lending limit rules is specific to credit exposure from derivatives or securities transactions. I was going into non-credit derivatives and how to calculate them. I was finishing up with credit derivatives, counterparty exposure, and referenced entity exposure requirements, and then lastly concluding the derivative section by saying that the appropriate federal agency may require the use of the internal model method, the conversion factor matrix method, or the remaining maturity method to calculate the credit exposure of derivative transactions if it finds such method is necessary to protect the safety and soundness of the institution. So for non-credit derivatives, the method of calculating the counterparty exposure for derivative and securities transactions has to be done the same way for all of your credit or for your derivative transactions. But the agency can step in and say that you use this particular method, one of the three particular methods for everything, instead of what the bank would choose. Securities financing is where I'm going to continue on page 212. A National Bank or Savings Association must calculate the credit exposure on a securities financing transaction by using one of the following methods. That's the internal model method and the non-model method. And the internal model method is approved by the appropriate federal agency, but the non-model method repurchase agreement exposure must be calculated and remain fixed at the value of the transaction at execution less cash received. Securities lending, if the collateral is cash, the exposure is and will remain fixed at the market value of the securities on the date of the transaction. If the collateral is other securities, the exposure is calculated and will remain fixed as the product of the higher of the two haircuts associated with the two securities as determined in the table in the regulation and the higher of the two par values of the securities. And that would be when the collateral is cash, the exposure is going to remain fixed at the market value of the securities on the day of the transaction. If it's other securities, the exposure is calculated and will remain fixed as the product of the higher of the two haircuts associated with the two securities as determined in the table in the regulation and the higher of the two par values of the securities. Reverse repurchase agreements. Third section under derivative transactions, credit exposure from derivatives and securities transactions. For reverse repurchase agreements, the exposure will be calculated and remain fixed as a product of the haircut associated with the collateral received as determined by the table in the regulation and the amount of cash transferred. Okay. Securities borrowing lists under the credit, derivatives, and securities section. You have cash collateral, non-cash collateral, and the mandatory use of the internal model method. For cash collateral under securities borrowing, in a transaction with cash as collateral, the exposure will be calculated as a product of the haircut on the collateral received as determined by the table in the regulation and the cash transferred to the other party. Non-cash collateral in a transaction where the collateral is other securities, the exposure will be calculated as a product of the higher of the two haircuts associated with the two securities as determined by the table in the regulation and the higher of the two par values of the securities. Mandatory use of the internal model method is the appropriate federal agency requiring the use of the internal model method on securities borrowing transactions if it is determined to be necessary for the safety and soundness of the institution, I should say. The effective date of the lending limits is basically the effective date of when you're calculating the lending limits is going to the end of the quarter or whenever they experience a change in a capital category. The effective date of the lending limit will be the earlier the date on which the National Bankers Savings Association submits or is required to submit its call report, or when the capital change occurs, whichever is more recent. The appropriate federal banking agency may require more frequent calculations. Combining rules for persons, corporations, partnerships, joint ventures, and associations, and foreign governments. Under combining rules, loans to one person will be attributed to another, and each will be considered a borrower if the loan proceeds were for the direct benefit of the other person, or a common enterprise exists between the parties. When the loan proceeds were for the direct benefit of the other person, the direct benefit occurs when the loan proceeds or assets purchased with the loan proceeds are transferred to another person other than a bona fide arm's-length transaction where the proceeds are used to acquire property, goods, or services. Loans to one person will be attributed to another, and each will be considered a borrower if a common enterprise exists between the parties. If the source of repayment is the same, then an employer and employee will not be considered a common enterprise solely because of wages and salary unless they are related through common control and are financially interdependent. A common enterprise exists between parties if the persons are related through common control and if there is a substantial financial interdependence between the persons, then a common enterprise will exist. Common control in this sense is the direct or indirect control of one borrower by the other, and substantial financial interdependence exists in this sense when 50% or more of one borrower's gross receipts or gross expenditures are derived from transactions with the other. And a common enterprise exists between parties also when separate persons borrowing to acquire more than 50% of the same business will be a common enterprise. And lastly, a common enterprise exists between the parties' control exists when one or more persons acting together can vote 25% of the shares of another person, or one or more persons acting together can control the election of a majority of the board of directors, or another circumstance exists that indicates that one or more persons acting together exercise a controlling influence over management of a company. So, the last way to determine if a common enterprise exists between the parties is basically by the ownership and control of the company. Loans to one person will be attributed to another, and each will be considered a borrower if they're corporations. 1, 2, and 3. 1. Loans to a person and subsidiaries do not have to be combined unless the parties meet the common enterprise test or the loans meet the direct benefit test. Loans to corporate groups may not exceed 50% of the bank's capital, an unimpaired surplus, even if they are not engaged in a common enterprise. A corporate group is a person and its subsidiaries. Subsidiaries, for purposes of this regulation, is a person who has at least 50% of his or her voting stock owned by another person, either directly or indirectly. Loans to one person will be attributed to another, and each will be considered a borrower if rules for partnerships, joint ventures, and associations, not if, but the rules for the partnerships, joint ventures, and associations are considered to be loans to each of the individual members, and loans to individual members will not be considered to be a loan to the partnership, joint venture, or association unless a common enterprise exists or the direct benefit test is met, and limited partners are not included in these rules. Foreign governments would be considered loans to one person and combined if they failed to meet either the means or purpose tests. And the means test is when borrowers have resources to service their debt obligations, and the purpose test is the purpose of the loans is consistent with the purposes of a borrower's general business. Interesting. Banks and savings associations must maintain documentation showing that the means test and the purpose test are fulfilled, including a statement from the legal status and degree of financial autonomy of the borrower, financial statements of the borrower for 3 years before the loan, or financial statements for each year the loan is outstanding, as well as the bank's assessment of the borrower's means of servicing the loan and a loan agreement that clearly describes the purpose of the loan. Restructured loans to foreign governments are not combined but are consolidated in a qualifying restructuring. They do not have to be combined for lending limit purposes, even though they are consolidated if approved by the appropriate federal banking agency. That sounds complicated. Let's try to get through the rest of this in less than a minute. We have non-conforming loans are not deemed to be a violation, but will be considered to be non-conforming if it is no longer within the bank or savings association limit because the capital is declined, the borrower subsequently merged, the borrower subsequently formed a common enterprise, the lenders merged, the lending limit or capital rules changed, and the requiring collateral securing loan has declined in value, or in the case of derivatives credit that is measured by the internal model method, the credit exposure increases after the execution of the transaction. I would think that the would be whether the collateral. Oh, okay, I get it. Okay, banks and savings associations will be next.